Hey guys, welcome back to another video. My name is Josh, and in today's video I'll be providing you with a portfolio update on my public shares portfolio. February was a busy month for the portfolio, with 3 of the companies that I have in that portfolio reporting their interim results or their full year results. And we'll also talk about what has caused a recent sell down in the markets, both overseas as well as in New Zealand. And I'll also be sharing with you what I'm doing in this situation. If you enjoyed today's video, be sure to hit like and subscribe. And as always, this is not financial advice, purely for entertainment purposes only. It's not a recommendation for you to buy, hold, or sell any of the stocks that I have in this portfolio and any stocks that I talk about in this video. You can read the full disclaimer down in the video description below, but let's get right into the video. So the Sharesies public portfolio currently is worth $14,840. It is up 19.36%, or a total return of $2,420. So during mid-Feb, the gains were roughly $3,000, and in the second half of February, the gains reduced down to 2.4K. So there was a slight decrease in the returns of the portfolio. And if you remember last month, which I'll show you, the returns were roughly 24%. So there was a slight decrease in the returns. Some of that was due to my contributions to the portfolio, because as I continually add money into the portfolio, the returns will go down, but most of it was caused by the general sell down in the markets. Now, in terms of the stocks that I hold in this portfolio, I haven't added any new shares, only topped up my positions. So we have Argosy Property, Auckland International Airport, Heartland Group Holdings, Infratil, Mainfreight, NZX, Oceania Healthcare, and the 5 ETFs being ASX 200, Australian Mid-Cap Fund, Emerging Markets Fund, NZ Top 50, as well as the US 500 Fund. So now let me take you through the Excel sheet that I have, which shows you the allocation movements in my portfolio. So over here we have Oceania Healthcare as the largest position that I have, making up 15.5% of the public portfolio. That's a change of negative 1.5%. So last month the allocation was 17%, and now it's 15.5%. And the reason being is the share price did drop quite significantly to $1.45 from $1.58 a month ago. So the second largest position is Heartland Group Holdings. They reported their interim results, and we can see that this has increased by 0.2% in terms of my allocation, and it's actually one of the 2 stocks that have actually gone up in my portfolio this month. It currently is trading at a share price of $1.89 from $1.86 a month ago. The reason being is because banking stocks have been in favor with this market sell down, as market participants rotate stocks out of tech, which have been the big winners of 2020, into more traditional value cyclical stocks such as banking stocks like Heartland Group Holdings. Now, in terms of the half year results that they reported, they did report a net profit after tax of $44.1 million, which is a 10.6% increase against last year's first half results, or 13.4% if you remove any impacts of one-off gains or losses. And in terms of the dividend per share, they did announce a dividend per share of 4 cents per share, and the reason for that slight decrease from 4.5 last year is because of the restrictions that were placed by the RBNZ. So if there wasn't any restrictions, then Heartland Group Holdings probably would have paid even more dividends. So the slight decrease in dividends wasn't an indicator of the company's ability to not be able to pay that dividend, but rather due to external factors like the RBNZ restrictions. So if the restrictions get removed, then I expect going forward that Heartland Group Holdings will pay an even bigger dividend than what they have paid in the past, to sort of catch up on dividend payments back to shareholders. So this is a really good result, an increase in net profit after tax, and they also gave us forward guidance for FY21. Guidance is expected to be in the range of $83 to $85 million, and I calculated based on today's share price the market cap of $1.1 billion. This puts Heartland Group Holdings at a forward PE of 13 times. I'll continue adding Heartland Group Holdings into my public account. Now, moving on from Heartland Group Holdings, we have Emerging Markets Fund, the US 500 Fund, the Aussie Mid Cap Fund, and ASX 200 Fund. And across all the ETF positions, the total change was 0.7%. So I have been adding a little bit more into the ETF positions as the markets all around the world have been selling down. Now, Infratil had a slight increase of 0.3%, and the reason being is also because Infratil was one of the two shares, other than Heartland Group Holdings, that had an increase in their share price from $7.20 to $7.36 today. So that's a really good result for Infratil. Now the next stock here is NZX Limited, so the company that actually runs the exchange. Now allocation wise, it did drop 0.3%, so that's not really too big of a difference compared to last month, but they did report their full year results this month. Operating earnings up 9.7% to $34.4 million. Record trading levels with 41.8% increase in value traded to $53.7 billion. Now, I'm not sure what exactly caused that increase in the record trading levels, but I suspect it has to do with a particular platform called Sharesies, where a lot of retail investors start buying small chunks of money, and that slowly adds up, as well as increased trading because of the Rona. A lot of fund flows in and out. Now, record growth across capital markets, smart shares, as well as the NZX Wealth Technologies. We also have net profit after tax of $17.6 million, up a nice 20.1%. In terms of the forward guidance though, they don't expect NZX to grow significantly, and their guidance range for operating earnings is roughly $31.5 to $35.5 million, which is in line with current year operating earnings. All right, so it is a decent result from NZX, and they do pay a 6 cents per share dividend. This Sharesies public portfolio is a dividend paying portfolio, so NZX does fit my criteria. I'll continue to hold NZX and continue to add as I top up my Sharesies account. Next stock on this list is Auckland International Airport at 7.3% of the portfolio, up 0.6%, and the reason being is because I have been adding more Auckland International Airport into my portfolio because there was a slight dip in its share price. As you can see over here, there was a dip in the middle of the month when they did report their earnings. Obviously, there's not many people flying around these days, so I took the opportunity to buy more shares during that time, and since then it's only gone up. In terms of their results, they did report a 65% decrease in revenue, a small underlying loss of $10.5 million, and this is actually the first time the company has made a loss in its entire history, which is actually quite interesting, right? So it does show how resilient the business is. Even during the worst time of travel in history, this company got out with a small loss. So that is a good sign because the company does have a lot of operations in real estate. Real estate is lifting up the business, and I continue to add this stock into my portfolio. Next stock is Argosy Property. It's a real estate investment trust, no change here. Main freight as well, 6.1%, not much of a change. And NZ Top 50 Fund, it continues to decrease as I stop adding into that position. So overall, the portfolio is up 19.36%. But now let's talk about what's been causing the share markets to go down. So just to give you a little bit of context, the NASDAQ is down 6.4% since mid-Feb. We also see the same thing, not as bad though, as the S&P 500, down 3.14%. Now the reason being is because people have been selling out of tech and moving it into more value and cyclical. Obviously the NASDAQ is tech heavy, so that is getting sold off more than the S&P 500. Now if we look at the NZX 50 in the past month, however, NZX 50 is down 8.57%. Now there's a few good reasons why the NZX 50 is down, one of them being that A2 Milk did report not very good results and the share price has taken a hammering. You can see my video here that I made on A2 Milk's recent results, and also that a lot of the power companies have been selling down after its meteoric rise in late December and early January. So that sell down has caused the NZX 50 to taper off a little bit. Now, what's been causing the markets to go down? Well, the only answer is the 10-year bond yield. So the 10-year treasury has actually been increasing and recently spiked to a 1-year high of 1.6%, a rapid move unnerving investors. So this was the highest level since Feb 14, 2020. You might be wondering, Josh, what does this all mean? So let me explain it to you in really simple terms with a risk curve. So here is a risk curve. It basically shows you all the different asset classes available and the risk profile. So cash is the least risky, and then moving up the risk curve, we have fixed interest, property, shares, and alternative assets like your cryptocurrencies. And then on this side of the axis, we do have rewards. So as you increase risk, you increase your rewards. Now, when bond yields go up, bond yields being fixed interest, when the rewards go up on this side, what this means is that people who are more invested in shares, people as in institutions like pension funds that have a mandate to earn a constant stream of income to pay out to its unit holders, they will look at the yields on bonds and say, oh, now the bond yields are actually higher, there's less risk with bond yields, so I'm going to sell some shares to move it into bonds. So they will move down the risk curve because that's just what they do. That is a clear mandate, and that is the push-pull of the markets in terms of bonds and equities. So this is all normal market movements. Looking at the grand scheme of things, however, it's not too big of an impact. Now we can see S&P 500 for the past year has returned 27.94%, still a really fantastic return and well above S&P 500 historical returns of roughly 6 to 8%. Same with NZX 50, 1-year returns 6.91%. So that is roughly in line with NZX historical returns as well. If you do own a lot of tech stocks, then you might have seen your stocks getting sold off first. It makes sense because tech stocks have done really well already. People are now profit taking from that. So personally, what I'm doing with this situation is that I'm taking advantage of that and buying some tech stocks. One of the stocks that I've been buying in my private portfolio is Plexure, PLX or PX1 now, the stock ticker. I've talked about this stock before on the channel. You can check out that video up there. But basically this stock has been falling quite dramatically and falling even more due to the recent sell-off. So it's still a small percentage of my private portfolio. And in terms of what I'm be doing for the public portfolio, I'll continue to add to my portfolio. My strategy hasn't really changed and probably won't change for the long term because consistency is key. If you're a passive investor, continue dollar cost averaging into your passive funds. And if you like to buy and hold, then buy and hold. It doesn't say sell, right? So not a recommendation, not advice, but let me know what you think of this entire situation. Hope you enjoyed this update. If you did, be sure to hit like and subscribe, leave a comment down below. I read all of your comments. So thank you for watching, guys. Until next time, take care.